1% can look tiny until it is repeated 360 times. Imagine the same house, same front door, same kitchen, same price, and Ben is looking at the same $400,000 loan. On one side, the rate says 6%. On the other side, it says 7%. The difference looks small, just 1 point, one little number on a screen. But then the mortgage turns that number into a monthly payment, and it does that again, and again, and again, for 30 years. That is where the small number stops feeling small. Let's make that plain. A mortgage rate is often treated like a sticker. The house has a price, the loan has a rate, and the viewer's brain puts the rate in a small box. 6%, 7%, fine. But a mortgage rate is not just a label sitting next to the house. It is an input to a payment machine. The machine asks a few questions. How much money was borrowed? What interest rate is being charged? How long is the loan? And what rules are attached to the loan? Then it turns those answers into a payment schedule. Not one payment, hundreds of payments. For a 30-year mortgage, that means 360 monthly payments. So when the rate changes, it does not touch the loan once, it touches the whole schedule. Here is a simplified example. Only principal and interest. No taxes, no insurance, no mortgage insurance, no fees, no points, just the payment machine. Ben borrows $400,000 for 30 years. At a 6% fixed rate, the principal and interest payment is about $2,398 per month. At a 7% fixed rate, it is about $2,661 per month. The house did not change. The loan amount did not change. But the monthly payment changed by about $263. Now 1 month is easy to ignore. $263 is real money, but it still looks like a monthly difference. The mortgage machine does not stop at 1 month. It repeats across 360 tiles. At 6%, the simplified total interest over the full 30 years is about $463,000. At 7%, it is about $558,000. That 1 point difference becomes about $94,000 more interest over the full schedule. Not because the house became nicer, not because Ben borrowed more, because the price of borrowing changed, and the timeline kept repeating it. That is the first mental model. The mortgage rate is the time price of borrowed money. It is not the house price. It is the price of using someone else's money for a long time. And long time is the key. If Ben borrowed $400,000 for 1 month, the rate would matter. But it would not have 30 years to express itself. With a mortgage, the balance is large and the timeline is long. That combination makes small-looking rate differences visible. Now the next hidden piece is how the payment is split. When Ben makes a mortgage payment, the whole payment does not simply reduce the loan. Part of it goes to interest. Part of it goes to principal. Principal is the borrowed amount that still needs to be paid back. Interest is the cost charged for borrowing that amount. At the beginning of a long mortgage, the remaining balance is still large. So the interest part of the payment can be large too. The payment may feel like one flat monthly bill, but inside the bill, 2 bars are moving. Early on, the interest bar is heavy. Later, as the principal balance gets smaller, more of the payment can go toward principal. This is why a mortgage can feel strange at first. Ben pays and pay. But the balance does not fall as fast as he expected. It is not because the bank forgot to subtract the payment, it is because the payment is first dealing with the cost of borrowing a still large balance. Over time, the balance shrinks. Then the split changes. Less of the payment is needed for interest. More can hit the principal. The monthly payment may look steady on the outside. The internal split is changing underneath. This is the amortization story. A mortgage is not just a debt number, it is a schedule, and the rate helps shape that schedule. There is another place people get surprised. The principal and interest payment is not always the full monthly housing payment. Real mortgage bills can include other pieces: property taxes, homeowners insurance, mortgage insurance, escrow. That is why this episode is not saying, your payment will be exactly this. It is saying, this is the mechanism inside the loan. The full bill can have more layers. Now add one more label, APR. The interest rate and the APR can look similar, but they are not the same thing. The interest rate is the rate used to calculate the interest cost of the loan. APR is a broader cost label. It can include the interest rate, plus things like points, broker fees, and other charges paid to get the loan. So the interest rate is important, but it is not the only cost label. One loan can show a lower rate because the borrower paid more upfront. That is where discount points come in. Points are money paid at closing in exchange for a lower interest rate. So a lower rate is not automatically a free discount. Sometimes it is a trade. Lower monthly payment here, more money paid up front there. Made Plain is not telling Ben whether that trade is good or bad. The point is simpler. Do not look at the rate alone and think you have seen the whole machine. The machine has inputs. Rate is one input. Loan amount is another. Term is another. Fees and points can be another. And the type of rate matters too. With a fixed rate mortgage, the interest rate is set when the loan is taken out and does not change. That makes the rate feel like a locked rail. The monthly principal and interest payment follows that rail. With an adjustable rate mortgage, the rate may go up or down. That does not make every adjustable loan bad. It means the machine has a moving part. The viewer should understand what part is locked and what part can move. There is also a reason two borrowers may not see the same offer on the same day. Mortgage rates are not only a headline number, they can reflect market conditions, but they can also reflect borrower and loan details. Credit profile, down payment, loan type, term, fees. So when someone says, mortgage rates are 6 point something today, that is a useful headline. But it is not the whole quote for every person. Now come back to the first picture. Same house, same borrowed amount, 6% on one side, 7% on the other. At first, that 1 point gap looked like a tiny label, but the label went into the payment machine. The machine spread it across 360 payments. It changed the monthly bill. It changed how much interest accumulated over the schedule, and it changed the feeling of the same house. That is the payoff. The mortgage rate is not the house. It is the price of time. When the borrowed amount is large and the timeline is long, the price of time becomes visible. Before, the viewer might think, the house costs $400,000. After, the better mental model is, the house has a price, but the loan has a time price. And the mortgage rate is one of the rules that turns that time price into a monthly life.